Iran conflict has turned global energy markets upside down. Brent crude is trading at around $108 to $113 per barrel, up over 50% in weeks, thanks to disruptions in the Strait of Hormuz, attacks on shipping and massive supply risks. If you're in energy mining or just tracking macro impacts or tracking the Iran war currently, this is the intel you need right now. Welcome to episode 1 of my Global Energy Shock Intelligence series, Iran War Edition. Today, we're diving into my core dashboard, the Global Energy Shock Transmission Dashboard, which goes from links oil to supply to inflation to financial markets. This is the exact model I build and update for clients that spot how geopolitical shocks ripple through prices, inflation, different commodities and currencies throughout the economy in my market intelligence consultancy firm. Okay, so what we have here is we have my global energy shock transmission dashboard. So this talks about the global oil supply that interconnects into inflation, followed by financial markets. Now, this data, before we start, is from the 1st of March 2026. I do monthly updates for this. So in my market intelligence consultancy business, for clients, I'll update more frequently. But for this particular model here, this data is from the 1st of March. So just keep that in mind. That's before the oil price went up over $100 per barrel, and we saw the full implications of closing the Strait of Hormuz. So to start off with here, gathered data from a range of different sources, World Bank, and in the description on the YouTube channel if you want to have a look through. So first up here we've got oil price versus global oil supply. Okay, investing.com was the source for oil price, and global oil supply, I'll have to get back to you on the source for that one there. Okay, so what I'm going to do here is I'm just going to bring this graph up just so we can have a bit of a look. All right, so I've got all the different sort of wars here or crises throughout the last 40 odd years, 30 to 40 odd years. So we can see here the average oil price. This is crude oil here, price per barrel in USD. And then the global oil production volume here is the turquoise or the green. And you know what that is in terms of million barrels per day. So that's the amount of volume that's produced daily there with, or yearly, I should say, the average annual production rate. So if I come over here and we'll start with, the Iran war started, or the Iran revolution started here when the new leaders came to power. With this data set starts early 80s. Here we start to see the relationship between these two variables. Gulf War, what we saw here was we saw an increase in global oil production and an increase here in global oil production volume. Over here at GFC, the global financial crisis in 2008, we saw a dip here we saw a surge, I should say, in the average oil price for massive dip post GFC of 63.92, the average there in 2009 calendar year versus 2008 calendar year, which was 98.58. And then in terms of production didn't really change a lot between 2008 and 2009. So just a big sort of revenue hit there for companies. And then here, we see COVID 2018 was sort of still quite high there for both the oil price and the production volume before it dipped in 2020 there to a very low $38 per barrel. And since COVID, up towards the Ukraine war, we see the oil price start to, really drop down here and then climb straight back up here with the Ukraine war. and then the price again starts to dip here before trending up again in 26 here, with the next geopolitical conflict. Okay, so you can see here that war, recessions, and tough times based on the last 30 odd years, the oil price increases due to production, you know, decreasing, um, especially, if you look at things like COVID here, production really dipped when prices dipped. GFC here, production was about the same, but it dipped just post GFC. And then over here, production dipped as well when the oil price dipped. Okay, so it's a bit of a relationship there between those two variables. Um, so some of the points that I just want to make here, the Strait of Hormuz being shut. So global oil markets remain high due to geopolitical disruptions. Roughly 20% of global oil supply transits through the Strait of Hormuz. When oil historically drops during geopolitical conflict, gold increases in value. So that's my next point over here. So when the oil price goes down, we know that production decreases from the first graph. If we move across here to the second graph here, with gold over here, we'll do this one down here. We can see that when there's a dip there in the average oil price, bang, gold increases down here. Okay, we saw that after the GFC. Down here, COVID. Okay, there was a big dip here in the oil price between 2018 and 2020, and we saw gold increase there as a result, making gold a smart hedge here against the oil prices and the cost of oil going down. And then we sort of have a look down here, sort of post war at the Ukraine, as the average oil price decreased. Before this particular conflict or war, we saw gold skyrocket up. Okay, so that's interesting as well from a hedging perspective. Activity in the Suez Canal has dropped by over 50% in March 2026. So that's another sort of bottleneck, which will bring global exports of oil down, which will limit supply and put excessive sort of demand on that grid, increase prices, petrol and fuel. And then, obviously you've got disruptions in supply chains that then correlate to increases in, in food and a whole lot of other different sort of businesses in the economy cost more to produce, therefore inflation goes up, and then that results in the RBA increasing interest rates. So the other sort of choke point is the attacks in Bab el Mandeb Strait, a crucial route that handles 12% of global trade and 9% of oil trade, rerouting around Africa's Cape of Good Hope. This increases transit times by 12 to 15 days and is resulting in insurance companies increasing their premiums. Okay, so that's disruptions there straight away to supply chains, which all when insurance companies raise their premiums, that there's a spillover effect there because it costs more to export the good or the product, and therefore those additional costs and expenses have to be passed on to the consumer. All right, so just a few key points here just to close this one out. We've got, this is another one, is what happens, what's the relationship between oil price and inflation? So if we come over here next, we can see in the Gulf War, we've got inflation here in the yellow, massive inflation here occurred. And then we go through here and there's little sort of spikes here in inflation. But, you can sort of see that COVID, resulted in a spike there in inflation. Um, and over here, we saw a bit of a dip in inflation sort of post COVID. So it's about to change again. Okay. So that's something to sort of note there. And then down here for our next one, global oil production revenue. So this is the money that's, yeah, this is the revenue in US dollars that's been created each year um, by the total production oil production volume. So this is just sort of an estimate here by sort of calendar year based on the available data. So total production revenue here in 2022, you can see here, I think that's 11 trillion, 369, yeah, 11 trillion odd. So it's pretty decent there, and you can sort of see over time what's happened. So you can see that global oil production revenues really climbed up since the 80s and the 90s here. It really exploded here through the 2000s in the mining boom here. And then it sort of dipped here post GFC, climbed up here, and then dipped again in 2014. And then a massive dip here during COVID, and then it sort of spiked up since. Okay, so um, it's really interesting. 2022 was a big year there, and 24 is a year that we'll probably use for comparison a bit later in this analysis. Um, so it's the average global inflation based on the past sort of 40 years. It's the latest production volume value based on the data that we have here, and this is uh, this is the result of the first part of this series. Thank you for tuning in.